If you work in institutional finance, or you want to, there is one concept you will encounter everywhere: Asset Liability Management, or ALM. It is not a strategy, it is not a product, it is a framework, and it shapes every single investment decision made by pension funds, insurance companies, and other institutional investors around the world. In this video, I will explain what ALM is, why it exists, and how it works in practice, with real examples from the two types of institutions where ALM matters most: pension funds and insurance companies. Let's start with the fundamental question: why does ALM exist? Most investors think about one side of the equation, the assets. What to buy, how much to allocate, what return to target. Institutional investors think about two sides simultaneously: the assets and the liabilities. A liability is a future obligation, money that must be paid at a specific time, in a specific amount. A pension fund must pay retirement benefits to its members. An insurance company must pay claims to its policyholders. A bank must return deposits to its clients. These are not optional, they are contractual obligations. ALM exists because of one simple truth: if your assets and your liabilities are not aligned, you have a problem. You may not have enough cash when you need it, you may be forced to sell assets at a loss, or you may fail to meet your obligations entirely. ALM is the discipline that prevents this from happening. Now let's look at the two key dimensions of ALM: duration and cash flows. Duration measures the sensitivity of an asset or a liability to changes in interest rates. If your liabilities have a duration of 15 years and your assets have a duration of 5 years, you have a duration mismatch. When interest rates fall, your liabilities will increase in value more than your assets. Your funding position deteriorates. This is one of the most common sources of risk in institutional portfolios. Cash flow matching is the second dimension. It means structuring your asset portfolio so that the cash flows, coupons, maturities, dividends, arrive at the same time your liabilities come due. If you need to pay $1 billion in 2035, you want assets that generate $1 billion in 2035. Not in 2030, not in 2040, in 2035. Let me show you how this works in practice with two examples. First, a pension fund. A large pension fund has committed to paying retirement benefits to 50,000 members over the next 30 years. The liability profile is long-dated, predictable, and inflation-linked in many cases. The ALM framework tells the investment team to build a portfolio that mirrors those liabilities. Long-dated government bonds and inflation-linked bonds form the core. They match the duration and provide the cash flows needed to pay benefits. A smaller allocation to equities and alternatives seeks additional return, but always within the constraints defined by the liability profile. The liability drives the asset allocation, not the other way around. Second, an insurance company. A life insurer has sold savings products to 100,000 policyholders. Each product guarantees a minimum return over 10 to 20 years. The insurer knows exactly when policyholders will redeem, and it knows the minimum return it must deliver. The ALM framework builds a fixed income portfolio that generates enough cash flow to cover those redemptions and honor the guaranteed return. Duration is carefully matched to avoid interest rate risk, and every asset decision is filtered through Solvency II capital requirements. Return matters, but only after liabilities and capital are covered. Now, what happens when ALM breaks down? Duration. Mismatches are the most common failure. In 2022, when interest rates rose sharply across the world, several UK pension funds faced a crisis. They had used leverage to manage their duration exposure, and when rates moved faster than expected, they were forced to sell assets quickly to meet margin calls. Liquidity dried up. The Bank of England had to intervene. This was not a credit crisis. It was an ALM crisis. The lesson is simple. ALM is not a theoretical framework. It has real consequences when it fails. So how do institutional investors manage ALM in practice? They start by modeling their liabilities in detail. Timing, amount, sensitivity to interest rates and inflation. Then they build an asset portfolio designed to match those liabilities as closely as possible, the liability matching portfolio. Finally, they add a return-seeking portfolio on top. Equities, alternatives, credit. To generate excess return above the liability cost. The balance between these two components depends on the institution's risk appetite, regulatory constraints, and funding level. Derivatives play an important role here. Interest rate swaps are used to adjust duration quickly without changing the underlying bond portfolio. Inflation swaps protect against inflation risk in liabilities. These are not speculative tools. They are precision instruments for ALM management. If you want to understand how an insurance company applies all of this in practice, the full investment framework, the regulatory constraints, and the portfolio construction process, we covered it in detail in our previous video. The link is in the description. In this channel, we continue to build on these concepts: fixed income, credit analysis, derivatives, and institutional portfolio management. If this is the career path you are building, subscribe and follow along. ALM is not a complex concept, it is a discipline, and once you understand it, you will see institutional portfolios very differently.